A simple momentum trading strategy. Couple of rules. Got a blue line, a red line. 50-day moving average, 200-day moving average. The average over 50 days of a stock price, the average over 200 days of a stock price. When the short term goes over the long term, it means it's good. When the short term goes below the long term, it means it's bad. The good thing is a golden cross, and the bad thing is also known as a death cross. What's the momentum trading strategy? When the 50-day goes over the 200, buy it. When the 50-day goes below the 200, sell it, regardless. If the stock drops 15% in one day, sell it. You buy the stock when it crosses over. The blue line goes over the red line. The 50 goes over the 200. You set a stop loss of a 15% dollar amount on the original purchase price. So out here, if we purchased 64, we want to sell it at about 54 and change. That's 15%. 10%, 6.4 plus another 5 is half of that, 9.6. Automatically. Don't use a trailing stop loss or a trailing percentage that goes up and sells after you've made a certain amount of profit. The objective is to buy a lot of small amounts like this and then to sell the ones at a huge profit when they get something like 200-300%. Let's say you have 10 stocks, you buy 10. If one you make 300% on, you make $2,000 out of it. And if you lose on 9, you lose 150 on each. What's that? 900 plus 450. So you still make like $700-800. That's the idea. But you pick the right stocks to make sure you don't lose that much. That's the strategy. So for instance, with PayPal, I would probably buy this one when it goes over that line, although the thing that makes me look at it here is it looks like it's going to go below it again, so I'd have to watch it. The interesting thing about this stock, though, is that if we blow this up, this stock has been in a downtrend for a long time, since October 22. It's past there, November 21, wow, long time. Couple of years. It's gone in a long downtrend. It's been a long uptrend there. If you go back to here, your uptrend actually started way back there. If we were to put, say, a horizontal line in here to look for a support and resistance line, maybe somewhere like there. We go across here, it's gone below it. It's probably time for the stock to go up unless this company is in real trouble. A couple of other things. You don't buy a stock that pays out dividends because it's not a growth stock. We're targeting high growth stocks. PayPal does not pay dividends. It may in the future, but it doesn't at the moment. Invest $1,000 and you'd set a stop loss 15% from the purchase price and you just sit on it. Check it every now and again to make sure it doesn't cross over the line again. If it does, get rid of it. That's the strategy. It's real easy. You do it with a lot of them. You pick your stocks using a screener, something like this. What are the screener rules? I've got to find a screener. The screener rules are the revenue growth is above 20, and I've sorted this by the most intense revenue growth stocks. I'm looking for high growth stocks, something like technology, health technology, technology services. I wouldn't go for retail trade, finance, probably not unless it's Bitcoin, although so far I have bought in the past. You want a low price because it's going to go up. You want reasonably good volume. So this is moving averages. We're actually looking for things that tell us that we should buy this one. Why? Because the moving average is probably, the 50 is about to cross the 200. That's probably why it's doing that. We're looking for stocks that are below, where the 50 is below the 200. You don't want something that's already crossed. That's no point. If it's way above it, you don't buy that one. It's not going to go up. You're looking for things that are going to go. I've got a dividend share set to 0. I've got the RSI, which is the relative strength indicator, below 30, which indicates that it's actually buyable, which is this little graph here, which if I make the screener smaller, you can see that it's actually pretty way down there. Relative strength low means it's counterintuitive. You buy it because it's weak. You don't buy something when it's strong. It's going to get sold off and you're going to lose money. You buy something when it's weak, when it's going to go up. When everybody else has given up on the stock, that's when it'll go up again. That's it. It's a simple momentum trading strategy.